If your home sells for $1.35 million, how much of that actually lands in your account? The answer can be 6 figures less, because the sale price is only the first of 4 numbers you need to know. I'm Ray Stendall with Stendall Realty Group. Number 1 is your contract price. Number 2 is what's left after selling expenses. Number 3 is the cash wired to you once the mortgage and any liens are paid. And number 4 is what you keep after taxes. I'll walk you through all 4, explain the compensation changes, and show you the most expensive cost of all, the one that never appears on your closing statement. Start with number 2, what's left after selling expenses. Your largest predictable expense is usually real estate compensation, and that's 2 separate decisions. One is what you agree to pay your listing brokerage. The other is whether you contribute toward the buyer's broker fee. The buyer's obligation to their broker is set in their written buyer agreement, and they can ask you to cover some or all of it in their offer, but you aren't automatically required to agree. Since August 2024, offers of buyer broker compensation can't be displayed in the MLS, so evaluate the complete offer, the price, the terms, the risk, the concessions, and your final net, because one line on its own tells you nothing. After that come escrow, title, and routine closing charges. For early planning, I use a rough allowance of about 0.8% for those, so on this $1.35 million example, approximately $10,800, although the actual quote may be higher or lower. Add about $1,500 for the San Diego County transfer tax. Property taxes get prorated through closing, and depending on what you've already paid, that can show up as a debit or a credit. If you're in an HOA, resale documents, transfer charges, and prorated dues may add to that amount. Costs also swing with where you are. Since a Carlsbad tract home and a La Jolla or Coronado property don't carry the same HOA, local compliance, and insurance considerations. After that come required reports or local compliance items, any repairs or credits negotiated with the buyer, and the money used to prepare the home. Now number 3, your cash after debt, where the headline value turns into actual cash. Your mortgage payoff technically isn't a selling cost, but it still comes straight out of escrow, and so does a second loan or a HELOC, any tax or judgment liens, and a PACE balance. Financed solar may need to be paid off or assumed, leased solar may need to be transferred or bought out, and buyers and their lenders scrutinize those terms. An online estimate may show $500,000 in equity, but your actual wire can be far lower after selling expenses. Additional loans, liens, and other obligations are cleared. And number 4, what you keep after taxes, the piece many sellers fail to budget for. Your net sheet shows the cash you get at closing, but it doesn't tell you what you keep after income taxes. A lot of sellers assume taxable gain means sale price minus mortgage. The tax calculation generally starts with the selling price, subtracts qualifying selling expenses, and then subtracts your adjusted tax basis, and documented capital improvements can raise that basis, while depreciation from a rental period can add tax exposure. If you meet the applicable ownership, use, and timing requirements, a married couple filing jointly can generally exclude up to $500,000 of gain, or up to $250,000 for an individual. But if you bought in a place like Encinitas or Carmel Valley 15 years ago, your gain can exceed that exclusion, and the taxable portion may be subject to both federal and California income tax. On sales that don't qualify for a withholding exemption, California may also withhold money at closing, and that withholding is an advanced tax payment, which isn't necessarily your final tax bill. That's a conversation for a CPA before you list, and I'm not your tax advisor, but this one costs real money when it's missed. Now put it together with round numbers, just to show the structure, and remember, this isn't a quote for your house. Suppose the home sells for $1.35 million, and the negotiated compensation plus the other selling expenses we just covered total $100,000. Number 2, your proceeds after selling expenses is $1.25 million. Suppose your mortgage and other liens total $600,000. Number 3, your estimated closing wire is $650,000. Then suppose your CPA estimates $30,000 in taxes after accounting for your basis, improvements, exclusions, and other tax rules. Number 4, what you keep after that estimated tax is about $620,000. One sale price, 4 very different numbers. Now the cost I promised you at the start, the most expensive one, and it never appears on your closing statement. It's the gap between the best result your home could reasonably have produced and the result you actually get. In more than 20 years analyzing the San Diego and Southern California markets, I found the most common cause is a bad launch, and overpricing leads the list. Start too high, miss the first wave of buyers, carry the home for months, and chase the market down, and the lost proceeds and carrying costs can beat the fees you are trying to save. The goal is the strongest early market response and the biggest net, and selling fast is usually a byproduct of getting that right. So how do you keep more? Launch at a price that draws the first wave. Prep the home so buyers compete. Skip the repairs that won't return their cost, and get your HOA documents ordered early. And when the math supports it, a targeted credit can solve a buyer's specific financing or repair problem without broadcasting a lower list price. A credit reduces your net just as a lower contract price does, so compare the complete numbers before choosing. Run all of it before you list, while you still have room to change the outcome. Before you set a list price or sign with any agent, get your real numbers first. Book a discovery call with me using the link in the description and bring your property address and your rough loan balance. I'll prepare a personalized seller net sheet showing your estimated selling expenses and your anticipated closing wire. And if there may be tax exposure, I'll give you the figures and the questions to take to your CPA. No obligation, no pressure to list. Know your numbers before you list. I'm Ray Stendall with Stendall Realty Group.